Welcome, ladies and gentlemen, and a good morning to you all. We're here for the Miton UK MicroCap Trust investor presentation. This presentation is being hosted on Research Tree by Doceo and Capital Access Group. As we proceed with this recorded session, investors will be in listen-only mode. We strongly encourage questions, which you can submit at any time through the Q&A tab on the right-hand corner of your screen. Simply enter your questions and press send. If you would like to leave feedback, please hold on at the end of the session and there'll be a short survey you can fill in. While the company may not respond to every question during the meeting itself, be assured that management will review all questions and, where appropriate, publish responses. You'll find these responses on the event page on Research Tree. But now, without further ado, I'd like to pass the baton to Gervais Williams, Fund Manager of Miton UK MicroCap Trust. A very good morning to you, Gervais.
Good morning, Sarah. Thank you very much for hosting this. And it's a good time to talk because markets are a little unsettled and small caps, particularly microcaps, haven't done very well over recent months, but we're interested in what happens next. So I thought we'd entitle this presentation, How the Retreating in Globalization Affects Capital Allocation and Why UK Quoted Companies Could be a Prime Beneficiary. It's a bold title. As always, we've got some risk warnings here, which are obviously important. Always take those into account. I thought we'd start by talking about the UK stock market itself. It's a stock market which has been out of fashion really for 30 years. During the period of globalization, when capital has become increasingly low cost, when it's been easy to raise new debt quite easily, particularly at lower and lower interest rates, this has been a period when the UK itself, the UK economy has done fine relative to international economies, but the UK stock market itself has been very much out of fashion. Specifically, quite a lot of the UK mainstream stocks are capital intensive in nature. What that really means is they put a lot of capital in, perhaps some of the mining and some of the energy stocks. Alongside that, some of the financials, some of the transport stocks, even some of the manufacturing and defence areas. All of these areas tend to have quite a lot of capital involved. And when you get into a good place where things are going extremely well, during the period of globalization, it's been easy for new competitors to come up and attack their margins and reduce the upside. And so ultimately, the UK stock market hasn't really appreciated very significantly compared with most international markets. We think this is going to be a feature which is going to be different, as we saw with inflation. Clearly, what's happened now is the cost of capital has been going up. It's not so easy to get debt. Cost of debt's rising. And even if you can get debt, the margin which the bank charges is increasing. So we're seeing a period of change coming through. During the period of globalization, though, I think it'd be hard to understate just how much the ongoing disappointment of returns in the UK market has affected institutional behaviour. Specifically, what's been happening is the UK market was relatively comparative to many international markets in the past. But as we've seen underperformance, then in spite of the fact the UK market might be relatively undervalued, we've seen ongoing selling. And as the ongoing selling comes through, not only does it make it harder for companies to raise money, but it means the cost of capital for many of the local companies has been increasingly penal relative to international companies. And therefore, they've made fewer acquisitions, they've invested less rapidly, and that's probably contributed to ongoing underperformance in this kind of vicious spiral of increasing sort of costs of capital at a time when other companies have actually had better costs of capital. So what happens is after 20 or 30 years, we currently have a position where the UK stock market itself stands at a valuation which we believe is well below many international comparatives. And so even if you generate similar cash returns, even if you generate invest in companies with good profits growth, you're coming from a much lower level, which implies that when they do recover, they can recover by a much more significant degree. What's been interesting about the ongoing reduction in interest in the UK market is even over recent quarters and months, we've seen ongoing selling. I think this has been in part related to the fact that actually the opportunity for investing in a wider range of assets at more attractive levels has increased in the last 2 or 3 years. We've seen that bond yields have moved up to much higher levels, and some investors are now happy to invest in bonds alongside their equities. And so they've sold some equities to buy bonds. I think the same can be true of cash. In the past, cash, the yield on cash was very, very low. Now you can get some decent yields on cash in bank accounts. Again, I think that's increased the holdings. But actually, also alongside that, I think people have seen the improvement in the valuation of the UK stock market. The UK market's held up better over the last 2 or 3 years in terms of the mainstream companies compared with international equities. And I think people have just seen this as a good opportunity to take cash out of the UK market. And so what you've seen here is this chart shows the ongoing redemptions across UK OICs in UK different strategies. The dark blue is the all company sector, the light blue is the equity income sector, and then the green is the specifically UK small company sector. And what's really been a feature is not just substantial sales, but sort of ongoing substantial sales at near record levels. And so it's all the more amazing in a way that we've seen the UK mainstream stock market holding up so well at a time when local selling has been so significant. And I think that is really sort of pointing to an increasing interest in equity income strategies, in lower volatility strategies, in strategies which generate a return from companies which generate capital surplus at a time when capital is short. From international investors. Local investors tend to have a good weighting in the UK. So actually it's not, most of those are still have a good weighting even now after it's been out of fashion for 30 years. But international investors have very low weightings in these kind of assets. And we are seeing renewed interest coming into the UK. And that's definitely one of the principal reasons we believe that the mainstream UK FTSE 100 index, for example, has held up so well versus international investors. But of course, the same pattern isn't there for the smaller companies. There's very little interest in from international investors in smaller microcap stocks. And so we've seen ongoing sort of net selling in terms of institutional portfolios, OICs, and we've seen very little new buying. And the net effect is the share prices of many of the smallest and quoted companies have actually fallen at a time when the mainstream market's held up pretty well. We've seen an extraordinary difference in performance over the last 2 years. If you take the FTSE 100 and compare it with the returns of the FTSE AIM All Share index, then what you see is actually the differential, the underperformance of the FTSE AIM All Share versus the FTSE 100 is some 50%. Truly extraordinary, given that they were all undervalued to start with. So beyond globalization, we see a different trend, but what's going to be really the key drivers of that change of trend? But this is a chart looking at the total profit margins, US profit margins in this case, of corporate businesses, excluding the financial sector. The financial sector, as you know, with hedge funds and things, can make money even in unsettled markets. But generally, this is looking at the overall mainstream stock market, mainstream economic returns on the US economy. And you can see in the past, back in the 1950s and early 1960s, there were good profit margins. Inflation was generally benign. We did see inflation starting to take off in the late 60s and early 70s. And with that, you saw a compression in profit margins. That led to unemployment rising. That led to some novel policies, which actually didn't work very well. That meant that profit margins recovered for a short period, perhaps 2 or 3 years, perhaps 4. And then later on in the 70s, and particularly the 80s, we saw profit margins across the US economy coming under massive pressure, huge downgrades, companies generating much less profit, many companies going bust, and it's a really unsettled period. So when you look at it in that basis, you've got a period where the mainstream stock market itself actually didn't produce anything like the returns that previously people have got used to. Basically, from about the early 70s, the US stock market moved into a very narrow flux of companies, what they would call the Nifty 50, a bit like our FANGs nowadays. And as those came under margin pressure, as economic growth was more patchy, as interest rates rose and the valuations reduced, then you saw the basic US stock market flatlining in real terms for 11 years. Our own view is that we're going to see something similar. You can see how profit margins have increased over the period of low inflation. You can see how they've increased further with extra cash being injected by governments and extra stimulus being injected over the last 3 years with the pandemic. But what you can see is there is a real scope, unfortunately, for profit margins to come under major pressure going forward, in the same way we saw back in the early 70s and the later 70s. So the big question is, as fund managers, not so much whether we can pick good companies, but how can we pick companies which actually can hold on to profit margins when many of the other competitors are cutting prices? The key issue for us is to invest in companies which aren't just generating good customer service, but outstanding customer service. If you're delivering outstanding customer service, yes, some of your customers may have to accept lower service levels and go elsewhere, but many of your current customers will stay with you and hopefully continue to pay you good profit margins on the back of it. So when we meet companies, one of the key questions is tell us about how how important the priority you put on good customer service. And the key question is not so much, do you do that, but actually, do you measure it? A lot of quoted companies talk about customer service as being important, but when you ask about their board papers, when you ask about the detail of their board papers as to how much of the measures they collect on whether they're delivering good or outstanding levels of service, it tends to be that the data is a bit flaky. And when you ask specific data about what it was last month or the previous month, or how it was last year, or how it was going through COVID, or indeed whether they do mystery shopping on some of their competitors, we see many companies begin to fall apart. Some of the management teams really aren't collecting anything like enough data, or certainly the priority for this area is not significant. So if you meet companies and you select for companies which generate not good but outstanding levels of service, then we think that in this period of kind of margin compression, we think they're going to hold up relatively well, continue to generate cash in many terms, and specifically, hopefully not just succeed, but thrive at a time when other companies are not doing so well. And we should really recognize that, aftermarket valuations have improved to such, relatively high levels. Bond valuations got to very high levels. Bond yields, if you remember, got down to relatively low levels, in some cases negative in some of the European markets, for example. And when you see that profit margins have increased, then if you do get the reverse going forward, particularly this is an example of what happened in Japan after 1989. In 1989, the Japanese stock market peaked and came under some margin pressure. Valuations fell back. Generally, as you know, the Japanese stock market hasn't risen much since December 1989. What you can see is the downside risk on quoted companies can be quite significant. So you've got to find companies which can't just survive, but actually thrive in this period. We believe that small companies, being small, have the ability to be growing even when the mainstream stock market is perhaps under pressure, when perhaps global economy is under recessionary pressures. Specifically, there's opportunities for them to be ducking and diving and moving into those markets which have been vacated by some of the zombie companies which are going bust. So we think quoted companies with their stronger balance sheets are already well positioned for the future. But most particularly, we also think that actually there's opportunities for them not just to continue to move into those opportunities, but actually take advantage of the weakness of the global economy, of the global stock markets. So bizarrely, a rising cost of capital, interest rate rises, companies finding that they actually their valuations are more tested, means that actually companies which have access to institutional capital, third-party institutional capital, don't just have the advantage, they have disproportionate advantage in our view. What we've started to see, unfortunately, is some companies are beginning to go bust. A few of the zombie companies, not many at this stage. We expect a lot more zombie companies to be going bust in the next sort of 6 and 12 months' time. And that will open up the opportunity for companies to expand. There will be more staff for them to take on to help them expand. And most particularly, there will be bad debts going through, which actually means that companies which are on the margin, perhaps vulnerable to failing, will start to find that actually they get some bad debts, and that makes it even harder for them to continue to survive. But most particularly, if you've got companies which are you can acquire from the receivers, perhaps, it's not just the £1 which they cost. I mean, we've all got £1 probably. We can all buy these companies for ourselves, but you've actually got to fund the working capital. Normally, when companies go bust, you find that the working capital is being collapsed, and you need to put working capital in. And at that stage, you can then actually revitalize the company, keep the staff in employment, and get the full cash payback on the back of it. And we think this is going to be an increasingly important feature. Many private businesses with a lot of debt, perhaps with the banks lending less, will find it hard to raise capital to invest in these companies. Many quoted companies can continue to buy these companies debt-free from the receiver and get the full cash payback. A lot of people say, well, that's all very well, but let's just go back to the 1970s. Back in the 1970s, the UK economy actually was a relatively weak economy. It didn't grow anything like as fast as perhaps the French or German economies, the US economies. Particularly, we had some very weak policies in the UK. We had marginal taxation on unearned income. That's basically interest income, rose to 98%. We saw periods when actually there was 3-day weeks to restrict companies in terms of energy consumption. We saw a period when actually inflation was coming through very strongly and interest rates were rising dramatically. And this was a period when actually the UK government itself ran out of cash. In 1976, the UK government had to have a rescue package from the International Monetary Fund of some 4 billion. And that obliged them to be very harsh in terms of spending, local spending. But what was interesting is this period was really defined by a long-term decline in the valuation of sterling. International earnings were worth more than local earnings, and that probably would have been something which you would have expected to be a disadvantage to quoted companies. And yet, looking at this data, this is not the last 30 years. Small companies have outperformed over the last 30 years in the UK, but then everything's outperformed the UK stock market in the last 30 years. Now, this is looking back in the 60s and 70s when inflation took off and lots of companies went bust. And you can see that dark blue line, the all-share index, companies generating surplus cash, cost of capital was going up, their ability to continue to generate capital returns was attractive because there was less competition coming in to compete than when they found a niche which was successful. That dark blue line was one of the best performing stock markets in the world back in the 60s and 70s. Cash surpluses are a great advantage when there's not much cash around. Perhaps more surprisingly is when you look at that light blue line, which is the bottom 10%, you saw that it wasn't just keeping up with one of the best performing stock markets in the world in the form of the dark blue line, but outperformed handsomely. And when you look down to small microcap companies and the green line, then they didn't just keep up, they outperformed even small caps along the way to generate much, much higher returns. So how did this happen at a time when the local economy was under pressure, when sterling was weak, and local businesses probably had a disadvantage versus imported earnings from overseas? And of course, it comes back to the point I was talking about earlier about acquiring assets from the receiver. And we've started to see this. And the example I like to use is Made.com, because Made.com had a valuation 2 or 3 years ago when it was in the middle of COVID. It came at a market cap around 500 million market cap. It did touch 775 million market cap. Clearly, it was very busy producing sofas for people who were at home and tarting up their homes at the time. As you probably know, subsequently, the demand came off, costs were still high, it didn't make a profit, it moved into heavy losses and went bust at the end of last year. Now, what was interesting about that company was it was acquired from the receiver, not for £1 in this case, but £3.4 million. It was bought by Next PLC. We don't know how much working capital was required to keep that business, get that business up and running again. If we assume the total valuation, including the purchase price, was say 30 million, I don't know if that's right, but just assume that for the time being. And if we assume that actually it's not worth 500 or 700 million, perhaps it was overvalued in those cases. Perhaps we can say it's worth, say, 330 million to make my maths easier. So Next paid 30 million for a business which added 300 million to their market capitalization and their prospects for earnings in the future. Well, coming back to that, of course, that was very good for Next. It's an £8.5 billion company. Every 300 million makes a difference to their outlook and enhances their return at a time when it's getting tougher due to a potential global recession. But of course, looking at this line, the reason I bring it up at this stage, of course, is companies which are a tenth the size of Next, 850 million market cap, who do the same deal for 30 million, buy 300 million of added value. Of course, 300 million on 850 million is 30 or 40% an uplift. And when you get down to the microcap quoted companies, these are quoted companies with investors like yourselves and ourselves who can raise additional capital. Clearly, if you're an 85 million pound company, you need to raise capital. You haven't got 30 million knocking around just to buy an acquisition. But if you raise additional capital, maybe at a discount, the market cap, perhaps a bit of extra margin, maybe your market cap, say 150 million after you've raised the new capital. But of course, adding 300 million in an uplift to 150 million market cap is hugely advantageous, disproportionately advantageous. We've hardly seen this pattern, but I think it's coming. I think there's going to be a global recession. I think that we're going to look into a period where a lot of the mainstream companies, a lot of the zombies fall over. We think the opportunity for acquiring assets from the receiver are going to be low. There's going to be low cost and enhancing in a way we just haven't got used to for the last 20 or 30 years. So coming back to it, I think the UK stock market itself can be a winner going forward, generating surplus cash when there's little cash around, using that cash to acquire assets from the receiver, taking market share from the zombies going down. But I think the UK small and micro-cap sectors can be disproportionate winners, one of the best performing parts of one of the best performing markets, which we think is a completely different position to where they've been for the last 30 years. And therefore, even drip, 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 small amounts of money coming into the blue line, light blue line, and particularly the green line, we think many of the mainstream funds, which are in small companies, will start to move down from the mid caps into the small caps and into the micro caps. We think this pattern is going to be hopefully an attractive return, opportunity for return for all of our clients. So what are the prospects for the microcap trusts specifically? Microcap trust is a trust. It's set up as an investment trust. And one of the advantages of investment trusts is that you can cap their size. They don't have to become unlimited in scale. One of the problems with unitized vehicles is when they do go well, you often find a lot of institutional capital comes in, and unfortunately, they get much larger than the investment universe. As a microcap invested business, then obviously we don't need to get too large in this fund. Yes, it's not that particularly large at the moment, it's 60 or 70 million, but most particularly it may get to say 300 million. It'll be down to the directors and the board to decide what size they let it get to, but it will be hopefully capped in size, which means that it can retain true to the sector even when it becomes a rich seam of investment return, which we expect. We particularly favour, Martin Turner and myself, who manage the fund, particularly favour companies which are going through a period of investment as it concludes. As it concludes, obviously they have to invest less in the investment going forward, but most particularly the return on all the prior investment starts to come through, and you go from a period where perhaps cash flow is not that significant or possibly marginally negative to cash flow becoming much more significant and positive going forward. And if that is the case, you can get disproportionate return. And that's pretty helpful even at times of recession when extra cash is value, well, irrespective of whether there's a global recession or not. It's an unusual strategy because we have a much longer list of holdings, perhaps 140 holdings. That means that actually we can buy and sell these companies. These are quite small companies, and so many of them aren't that large. So, we can buy in all sorts of different types of companies. But having the wide range of companies means that when we do get some wrong, and we certainly do get some wrong, it means that they make a minor difference. Clearly, when we get them right, they have sort of option value upside. And if they have an option value upside, sometimes you can make a number of multiples on your investment return. And that's a very attractive feature, particularly when stock markets themselves might be certainly not appreciating much and potentially flatlining in future. And the final point about the bottom end of this microcap sector is there aren't very many professional investors, quite a lot of private investors, but we have opportunities to meet these companies. We meet very large numbers of them and pick out the upside. So we can buy those which actually, hopefully the downside's somewhat limited, but hopefully the upside isn't just 30 or 50%, but sometimes could be a multiple of the original investment. And these are the 5 areas of difference. It's a very different strategy compared with perhaps some of those strategies which tend to buy into companies which might be an Apple at a potential new Apple or that equivalent. No, these are ordinary companies generating surplus cash, investing hard, but a much wider range of sectors, not just necessarily the technology sector. We've been in a period where actually the UK has been out of fashion before. If you look back in the 2019 period when we had the May government, this was a period when actually there was a real anxiety that we would go through Brexit without any agreement with the EU and move on to the World Trade Organization trading conditions, which may have been much more restrictive than they are with the agreement. And most particularly, there was anxiety about the smaller end of the market and the UK economy at large and how much that affects things. And you can see here, in terms of the performance of the fund, its NAV in dark blue fell back quite a long way below the FTSE 100 index. But what was interesting is going through the pandemic, of course, it came down a little bit for that. As we got into recession, some of the smaller quoted companies were able to continue to find areas of expansion. They were immature, as opposed to other businesses which were more affected, particularly the mainstream companies, more affected by global recessions. And this led to not just a period of catch-up performance in the first sort of 2 or 3 months after the market bottomed, but then ongoing outperformance over a longer period. And over that period, the NAV of the trust rose from sort of late 30s up to a bit over a pound. So you saw it was a really very exciting period of outperformance when the mainstream stock market, FTSE 100, didn't perform that well, but particularly some of the smaller microcap companies performed very, very strongly. This period ends in May 2021. What about the last 2 years? I don't think I need to tell you what's been going on. As I mentioned, there's been ongoing redemptions In spite of the redemptions, the mainstream FTSE 100 has held up, not because local sellers haven't been there, been plenty of local sellers, but international investors have been coming in to buy low beta stocks, having portfolios of high beta stocks. They're rebalancing into low betas. They're coming in at a faster rate than we're selling locally. The FTSE 100 has held up really well, and with the income, it's produced a positive return when many of the international stock markets over the last 2 years have not done so well. But alongside that, you can see particularly small companies and microcaps, and this is showing the NAV of the microcap trust has come down enormously, and we've got that massive gap opening up. And so even companies which are continuing to succeed aren't necessarily getting the upside. Companies which are disappointing, unfortunately, are very vulnerable to kind of finding that actually their share prices don't just fall, but fall disproportionately. When you look at the performance of the fund, it's been very weak over the last 2 years. It was pretty strong over the last 4 years. And since launch, it's produced some return, but again, not as strong as the mainstream stock market. So you've seen the mainstream stock market outperform, but most particularly, you can see the Numis 1000 index, which is the bottom 2%, again, has outperformed. I think the smaller end of the smaller companies has been particularly weak in the period. What we've seen in the last, say, 6 months, the fund's coming through to 6 months in the first half of the year, is the NAVs continue to fall when many mainstream companies have continued to outperform. And so people ask me, well, what is it? And what we are seeing is many of the mainstream companies aren't going up as much as we would like, but also there are some companies where they continue to succeed and the valuations are still falling. I could talk about Totally, for example, which is a company which is involved in helping the health sector manage, hospital visits and the 111 service. Again, continuing to be successful, continue to generate cash, in this case paying dividends. It's maturity where it's paying dividends, and yet the share price over this year to date has detracted 0.9% from the fund. Frontier IP is another example, a company which is involved in technology. It's got some late maturity companies which are coming to fruition in terms of return. It has made a very substantial return in the past on a company called Scientifica, which is quoted on the NASDAQ. They've taken a substantial company. Again, these companies are well capitalized, strong balance sheets, not vulnerable to raising new capital. There are one or two which have disappointed, which may need to raise new capital, but most particularly, and we've had to sell one or two, independent oil and gas has cost the fund about 0.5% in the last 6 months. But most particularly, we've got companies which still have upside potential, where the valuation was overlooked, where they haven't really moved up or possibly moved down in this period. And so the risk-reward ratio, in our view, a bit like you saw back in 2019, is particularly attractive as far as we're concerned. If anything, we think going forward, we think the problems with inflation will be returning, not all the time. There will be periods when inflation goes away, and there may be periods when we're worried about deflation. And my short-term worries over the next 6 or 9 months is that actually inflation will fall so fast. I think we've increased interest rates so much, and most particularly, with the effect of those interest rate rises beginning to have a significant effect after a lag, then we could see unemployment picking up. We could see companies becoming insolvent. We could see investors, with mortgages to pay, being more cautious. So you could see this period of deflation. But whether it's inflation or deflation, it's not that kind of Goldilocks period we saw in the period of globalization. Companies generating surplus cash, companies after a period of investment generating disproportionate surplus cash, can not just survive but thrive. Particularly small companies, small micro-cap companies, which are immature in their marketplaces, continue to expand. We think the UK market itself is entering a virtuous spiral. It has outperformed over the last 2.5 years. It won't outperform every quarter or every year, but we think over the next 5 and 10 years, it will be one of the best performing stock markets in the world. And most particularly, further down the market cap range, as you go into the mid caps and small caps and into the micro caps, we think you'll get better and better returns as you move down these market cap sectors. And many of the professional investors will start to get in because there's very few other areas of rich seam of return. So we think this could enter a virtuous spiral, and the UK market will be one of the best performing, and the small cap market will be best performing part of the smaller cap of the UK market. And if we can add some value through the stock selection on top, all the better. And this isn't the first time this has happened. If you look back in the past, this is looking at the relative performance of the all share index. When this line is rising, the all share index is outperforming the S&P 500, and when it's falling, and you can see this starts in 1965. So we've had a long period where the UK all share index has underperformed the S&P index on a fairly sort of persistent basis. Yes, there were periods of inflation picking up back in the early 90s. Again, in just before 2008, there was a period where inflation picked up. But generally, inflation has been benign for 30 years. And we've got a whole sort of slew of investors, a whole slew of companies who haven't really seen that period when the UK market outperforms. It has stopped outperforming. The mainstream stock market's already started outperforming. We've seen the train leave the station. We've got this catch-up trade for the smaller companies, and most particularly for them to acquire assets from the receiver and generate disproportionate returns. The bottom line is that we see the opportunity for globalization to start peaking out. We've already started seeing the signals in that way with the pandemic, which has accelerated it. Of course, we've seen the invasion of Ukraine, which has also highlighted the problems with relying on distant supply routes. But most particularly, we can see this opportunity not just coming through, but as we saw, as interest rates bear down on companies, as quoted companies start to acquire assets from the receiver, we see the opportunity for upside is all the more exciting. So to summarize, the UK stock market is different from most other global stock markets. You get surplus cash. Even if the stock market doesn't go up, you get this cost compounding. They pay a dividend, and that dividend rises over time. So you can get a return even when the stock markets aren't rising. Microcaps have a history of outperforming. As I say, they've outperformed over the last 30 years. Of course, nobody minds when the UK is underperforming, and outperforming an underperforming market isn't very exciting. But most particularly, this strategy has been set up to take full advantage of the very specialist nature of this universe. There aren't many stock markets in the world which have a microcap quoted investment universe. We think the opportunity with strong balance sheets, not just survive, but thrive, is particularly exciting, particularly with the ongoing artificial depression of valuations due to UK OIC selling we've seen recently. And most particularly, we anticipate the UK stock market has already entered a period of virtuous spiral. We think smaller microcaps will enter a similar period. We're particularly excited. Thank you very much for listening today.
Thank you very much, Gervais. Thanks so much for giving the time to the presentation and some very interesting ideas coming up there. Particularly, I have some questions in, so I'll have a look at some of those. So your idea of the virtuous spiral, it's enticing to think that the UK could be one of the best performing world markets in the next 5 years. But what might be the catalyst to see that really start to happen?
Yes, I think what was interesting is I think the last 2 years we've seen inflation take off. I think that's been a catalyst. We've seen the UK outperforming, and most particularly when inflation takes off, it basically starves everyone of cash. We all run out of ready cash, and that includes us, individuals, consumers. We will notice our mortgage rates going up, and the cost of buying the things in the supermarket have gone up, and we've all got less cash to spend. But that's very much true of corporates. Companies themselves run out of cash, and governments as well. We see the governments looking to put up taxes here and there. So coming back to it, when companies run out of cash, for the first time in 30 years, if you kind of take the hare and the tortoise analogy, hares have been very much brilliant during the period of globalization, and companies which grow fast and move fast and all the rest of it have seen their valuations move up considerably. And they've used cash raised from the company, from the corporate markets to fund that growth. So you've been able to run cash flow negative models and make heaps of money for clients. Specifically, of course, when you run out of cash, then companies which are generating surplus cash already become hugely valuable. Companies which are unable to invest because they can't raise cash, they're cash flow negative or potentially go bust, come under enormous pressure. So I think we're entering a period of moving away from hares to tortoises. So coming back to that, I think the tortoise in the mainstream FTSE 100, that tortoise has already started to move off in the last year or two. But what we haven't seen is the microcap tortoises really move up. These are companies which are generating cash, but most particularly generate disproportionate cash in future years. And with the recession, as we start to see the selling reduce in the OICs, we think the UK stock market will break out just like Japan. But at that stage, we'll start to see small caps particularly outperforming the microcaps, hopefully be one of the best performing parts of that market when that happens.
Great. Well, yes, we hope that comes true. Now, to everyone present, I would encourage you to consider to continue sending in your questions using the Q&A tab in the right-hand corner of your screen. As the team goes over the questions we've received so far, I'd just like to point out that a recording of this presentation, together with the slides and the published Q&A, will be accessible on the event page shortly after this call. Now, to come back to the questions, Gervais, how do you research such a large universe of stocks to decide which are the right ones to invest in? And then I suppose associated to that, it's a large universe, but also, your sort of 130, 140 stocks is a large portfolio. So first, how do you filter that? And second, how do you keep on top of that long stock list?
Yeah, so I think there's two things to mention here. First of all, the number of quoted companies in the investment universe, say below 150 million market cap, which is the principal investment universe for the microcap trust, is very large. There's more quoted companies which have a market cap below 150 million market cap than there are above it. So we've got no shortage of opportunities, and so there's a very large number of companies for us Martin and I, to research. But coming back to it, in a way, it's not so much about making sure we've got the very, very best performing stocks every year. Of course, we'd love to have them, but it doesn't matter as long as we've got lots of stocks which have performed very well, whether they happen to be number 1 or number 10 or number 25 in terms of performance league, doesn't really matter. There's so many hundreds of companies to get involved in. So coming back to it specifically, we don't try and just go for the very, very top performing stocks. Sometimes they're a bit risky. Sometimes the valuations are high when we go in. So we particularly just meet the companies, and we meet very large numbers of companies. And when we meet the companies, we try and get an understanding about where they are in terms of their investment cycle. Have they come close to the end of investment? Are they entering a period where they're going to generate surplus cash? And are they going to generate disproportionate surplus cash in future? And those kinds of things are relatively easy. These are one product companies in many cases. When you enter finish a period of investment, you should expect sales to go up. So we are looking for extra sales. That's where the cash is generated from. We look for companies which can hold on to margin. I talked in the presentation about the importance of customer service. Clearly, another feature is just how much you've invested, differentiation. Then you can go into things like the management team. Unfortunately, some management teams are overconfident. And the problem with overconfidence is that sometimes people can end up taking more risk, and you can end up as a shareholder wearing that risk because it goes wrong. So coming back to it, we look for management teams very much feet on the ground, so sound people. Ultimately, things do go wrong, and sometimes things take a bit longer. And it's not the end of the world if share prices go down, as long as they fully recover and move up to new highs in the future. Again, to try and reduce that risk of new capital being raised, we tend to buy companies which tend to be quite strong in the balance sheet department. They have strong balance sheets. It means the cash can go down before it goes up, but most particularly, it means they don't necessarily need to go to investors and ask for new shares in the same way we saw in some of the banks in 2008. And that's long-term dilutive. And the last point is we are very mean. Martin and I really do want to pay low valuations. It means that when we get these companies, yes, they can go 30 or 50% up over a number of years. But sometimes if we're lucky and the company does really well and it makes a transformational acquisition and perhaps one of its competitors goes bust, then sometimes you can make a multiple on that original investment. So coming back to answer your question specifically, Sarah, we meet very large numbers of companies, many of which we don't hold, many of which are raising money, many of which are perhaps just at a turning point. And we try and pick those which are well positioned to generate disproportionate cash flow going forward. To come to the second part of your question about the number of holdings, many of the companies in the portfolio are quite small. If we were to cut off the market cap at say sort of 25 million or 50 million, then of course we could have a fewer number of holdings. But most particularly if this fund got larger, and as I say, my personal ambition is it does get to 300 million or say that sort of size. If you've got say 50 holdings or 20 holdings, then of course, as you've got 300 million, with 50 holdings, each of those holdings are going to have to be 6 million in size. Well, coming back to that, if you want to invest in a 25 million pound company, you can't buy 6 million. You artificially cut off the very microcap aspect you're talking about. So the large number of holdings means that we can invest in 25 million pound companies and even some 10 million pound companies. And when we do go wrong and we do need to sell them, there's a relatively small holding which needs to be sold, which means we can exit these holdings and re-enter these holdings. So coming back to it, it means that actually we are better positioned to actually participate in small micro, and most particularly, we're better positioned to remain true to the sector in terms of the risk. So the risk can be managed, but the upside hopefully comes through in dramatic size, as we saw briefly in the last cycle when markets recovered, particularly in the sort of 2020 and 2021.
Thank you. So we've got some new questions coming in from the audience. I mean, one thing that I wanted to ask, further to what you just said about, sometimes you need to exit positions. Do you do a lot of trading, or is the portfolio relatively stable? And also a question from the audience related to that. Can you list a few companies you bought and sold this year?
Okay, so coming back to that, yes, the whole point about the fund is that there are opportunities to trade stock. When a company gets expensive, we can take some profits. When a company goes down, we can buy some more. Clearly, you've got to be convinced that you're doing the right thing. Clearly, sometimes companies go down because the prospects are less good. Sometimes when companies go up, you can sell them too early. So, but coming back to your key question, yes, we are always changing the portfolio in small amounts, to be fair, and not hopefully disturbing the market price. So one of the perverse features of a microcap fund is, as a company succeeds and as it moves beyond 150 million market cap to 250 to 500 million market cap, of course, the scale of that becomes then much more interesting to many of the mainstream institutional fund managers. And so you can sell these companies not just at attractive valuations, but much higher valuations than they might be where they are currently. So the opportunity for the virtuous spiral isn't just that you get stocks which move up, but it moves into a wider investment universe. Coming back to it. So looking at the kind of companies which we've been adding to, we have been topping up some of our existing companies. So some of the companies which have been disappointing, Totally's been disappointing, HiQ has been disappointing, Frontier IP has been disappointing. These have all cost probably between those three, they probably cost 2.5% to the fund this year. We think the cash balance sheets are strong. We think they're well positioned for the future. We think that therefore it's worth adding to companies like that. On the other hand, some of the companies have succeeded where share prices have gone up, but they've just not gone up anything like enough. Perhaps a good example of that is U Group. It's had a 42% upgrade recently. And okay, it's up 30% this year. It was undervalued to start with. It's generating more cash than we originally expected. We think there's still room for further upgrades, bizarrely, in future. But most particularly, its share price, whilst it's added value, hasn't added that much value. So the opportunity at the moment is to look at companies, some which are raising new money, some which are just companies which are been in the portfolio in the past. So we've put a couple of new holdings in. Perhaps an example of that is in the oil sector. We've seen a company which is involved in. Oops, sorry. I lost you for a second. So companies in that is a Petromatad, for example, which is a company which has come into the portfolio. It's doing some high impact drilling. Okay, Mongolia, risky place. It's actually one of the main operations of Rio, so it's not just the big companies don't operate in these areas. The share price has already performed well. In fact, we've already taken about half of the profit on that because it's risen so substantially. So there's quite a lot of work going in there. In terms of companies we've sold, Independent Oil and Gas. It had it had the pipeline coming ashore. It was drilling out its wells. It was bringing new gas on stream. Unfortunately, there was quite a lot of water involved, and they were slow to get it on stream. And there's been extra costs, and the risk reward ratio doesn't look as though we're going to generate the cash. It has cost our clients money. It's fallen this year by it's cost about 0.5% this year, but we have exited that holding on that basis.
Thank you. That's interesting that two of your examples there were in oil and gas. So one of our audience asked, talking about cash generative small caps, what do you think of oil small caps? Many pay dividends and have very good balance sheets.
That's absolutely right. I mean, we think energy is the cornerstone of the economy. Don't get me wrong. We think we need to go through energy transition. It's important to try and be careful about the carbon in the atmosphere going forward. We think windmills and batteries are going to be a part of the future. But in our view, we're transitioning too fast. We're sort of holding back in terms of local investment, in terms of energy, at a time when we could run out of dollar bills. What happened in the 70s was governments ran out of dollar bills and euros. And effectively, that's why the IMF had to come in. So actually buying our energy from the US via LNG, liquid natural gas, which is very capital intensive and very carbon intensive. The carbon intensity for bringing new liquid natural gas to the UK is that about a third of the energy used in burning that gas is actually used in actually compressing the gas and getting it cold enough to start with. So coming back to it, much better to have local investment in either onshore gas fields or possibly gas fields which are low carbon intensity offshore, because at least we're paying pound notes for those. So coming back to it, I think that the energy price is coming down. The oil price is weak at the moment. We've got things, actually some medium-sized companies which have been coming under real pressure recently. Kistos is in the portfolio, as you know, it's come down recently. It's got net cash in the balance sheet. It's got the opportunity to invest. It's accelerated its investment through its recent acquisition in Norway. But most particularly, we think the whole sector's overlooked. Many fund managers, particularly professional fund managers, are quite cautious, partly because global growth is going to be slow, partly because the oil price is being slow. But valuations, I strongly back your questioner. The valuations are stunning. Many of these companies are 2 or 3 times PE ratios with net cash balances. I think the same is true of many of the material sectors. So some of these companies, which are mining companies, again, in generating surplus. We need more mining products, perhaps lithium. There's a couple of lithium holdings in the portfolio. There's opportunities to invest in some of the higher valued precious metals, which are not always the prospects for those are not always closely correlated to the stock market or indeed the economy at large. So, and again, some of the financials, again, these are capital intensive businesses where the prospects for return are enhanced by higher interest rates. Absolutely, these are sectors which aren't very fashionable, but they generate plenty of surplus cash. And when they come right, boy, do they come right. So overall, yes, I strongly back the questioner in this case.
Jolly good. Now, another question that's just come in from the audience, again, builds on that. So you say, the oil and gas area is not very fashionable, but something that tends to be quite fashionable at the moment is sustainability. So someone has asked, do you invest in sustainable industries such as sustainable aviation fuel, such as Velasys, or ceramic brake manufacturing such as Surface Transforms?
We certainly look at those. We believe Velasys has actually reached the point now where the cash is going to start coming out. So the portfolio has entered into that holding recently. Unfortunately, the share price has come down like many others this year. But yes, we're very happy. But coming back to it, we think sustainable is absolutely important. But actually, what's interesting about the sustainable agenda is when you look at many of the mainstream companies, of course, the investors engage hard and they have quite big teams which are involved in producing reports and all the rest of it. But each individual investor actually has a relatively small portion of the mainstream companies. So their opportunity to influence the agenda is quite limited. One of the advantages of many of the smaller quoted companies is, of course, there aren't many institutional investors. A portfolio like this might have quite a significant portfolio holding. It may be 3, 5, 10% of the company. And so we can engage with the management team and hopefully work with them to enhance the prospects for sustainable agenda so that they invest harder. Hopefully they get better cash paybacks on the back of it. So coming back to it, I'm kind of been interested in my carbon footprint for the last 30 years. I didn't have a car for a large part of that period. So coming back to it, I'm hugely interested in the sustainable agenda, but I don't think we should just be sort of just saying, right, we mustn't invest in the oil sector. We need energy to phase out. We need a carbon-based energy to phase out. We need new energies to come in, but we've got to generate some attractive returns. One of the features about the strategy which Martin and I follow is that many of the more attractive, exciting companies in the sustainable agenda tend to stand on relatively high valuations. And for that reason, we haven't got that many in the portfolio. Velasys is an example which we do have. Great,
thank you. So another question that's just come in from an attendee. I mean, I think you touched earlier on a company where you trimmed your holding because it had done particularly well. And I suppose this hinges on sort of, the idea of price targets perhaps, but they've asked, by selling holdings that are doing well and investing in companies that are doing badly, aren't you ensuring that the performance of the fund is likely to be lower than it might otherwise be if you sold low performers and invested more in companies that are doing well?
Yeah, I mean, I suppose what I'm
saying, isn't it?
Yeah, there's 2 things. First of all, when companies do well, they become bigger and bigger parts of the portfolio. And that's great on the way up. But if you do suddenly find that they disappoint unexpectedly for whatever reason, or there's a change in the market or whatever, suddenly they can fall very dramatically. So you do carry relatively high stock-specific risk. Now, if it's a company doing well, we can tolerate some stock-specific risk to some degree. U Group is over 5% of the fund at the moment, and we're not trimming it, actually. We think the risk-reward ratio is so attractive that we don't wish to trim it, even at 5%. So we're running a winner there, for example. The areas where we're trimming are where we find that our traffic light process throws up uncertainty. We look for companies which generate good sales growth. If there's a period where perhaps sales growth is leveling off a bit, perhaps not growing as much, then there's less cash generation. So we would see an orange light or possibly red light coming in. A single red light as a sell signal. The same in terms of margin, and the same in terms of some of the management teams. Some of the management teams have become a little bit more confident. They're doing well. They start to think they can do rather better than they perhaps can. And that stage, we might trim them. Balance sheet. If you start to get so confident you don't need the safety margin in your balance sheet, you allow your debt to start building up in the company. Again, that's a sell signal. But probably the most common reason for selling holdings isn't because they're not doing well or they're not excellent companies. It's the valuations have moved right up, and we look for companies where the valuation is higher, and we take profits in those and put it into companies which are at much lower valuations. So what we really want to do is make sure that we keep rotating into companies where that sort of option value upside is very substantial, albeit that we are sensitive to stock-specific risk. And that's not just individual stock-specific risk, but where you've got 3 or 4 companies operating perhaps in the energy sector, where you get so much weighting in the energy sector, you're vulnerable to oil price weakness, and you take a few profits on those. So don't get me wrong, I can see where he's coming from. The companies we invest in aren't unsuccessful. We believe they're going to be very, very successful, and they're ultra low valuations. And when they come, as they come through, as they get larger, of course, institutions get involved, and we get this kind of virtuous spiral going on. It's just not been working over the last 2 years when we've seen these OIC redemptions, where some of the companies we invest in, yes, they're doing well, like Velocis, but their share prices have gone down irrespective of the fact they're doing well.
All right, thank you. Now, honestly, we could talk about this all day, but unfortunately, we've run out of time. So, Gervais, we very much appreciate your generosity in addressing all of these questions. Should there be any more, they'll be made available to you right after the presentation for you to review. And it would be greatly appreciated if you could provide your responses where suitable, and we'll add these to our event page.
That's right. Thank you, Sarah. I mean, I was going to just emphasize, we like to measure customer service. So if please do fill in the survey. And if we're not doing well enough, or if you want us to adjust the presentation to make it better for you, please do tell us, and we can improve. So we're just like one of the quoted companies in the portfolio. We can do better too.
Thank you. Yes, well, you've taken my outro there. But yes, so to all our attendees, we do sincerely appreciate your participation in today's presentation. And so now we'll bring this session to a close. Good day to you all.
Thank you very much, Sarah.